sorry for being late a little bit. We promise not to bore you to death. We know it's late. So we will discuss something you heard all of it. It's about how we can prop up the economy, which is now in a real malaise. The recovery is slow. I'm not going to bore you with details. We all know that. So we will try to focus and bring you into the topic of what financial instruments can be used, what the financial instruments are, and how these instruments coming from the public side and private side can help to maybe fasten and kickstart the real economy and help with the recovery. I'll start with introducing our distinguished panelists. To my right side, it's Peter Jeffries. He's coming from the EIB. He's a guru who knows lots and can explain by definition and by in reality what financial instruments are. Then it's Robert Augst in the middle. He's the new head of Slovak Investment Holding, who is a new baby created to leverage and use European funds and how to find ways how to invest in real economy. Then it's Antonis Gravanis from Greece, who is now deputy head of agricultural products and trade promotions unit at Enterprise Greece, and he will shed some light how Greece put these measures in place, and maybe it will help us to see in reality what it means and how it works. Then it's to my left side, it's Jean-Christian Six. He's coming from Luxembourg. He knows lots about, he's coming from an infrastructure funds working group, which is helping governments and private entrepreneurship with logistics and consultations, and he knows lots about the legal aspects and also how it goes upon in place. Last but not least, it's Trevor Sturmey. He's coming from HSBC from London, so he's coming from the evil bank side, but he's an expert when it comes to PPP and infrastructure projects. So much for the introduction. I'm not going to go into any further details, and we can kick off with Peter, who can actually walk us through and shed some light what financial instruments are and what is the use and meaning of it and why we should go for financial instruments.
Okay, thank you. I guess financial instruments are just a really much more efficient way to deploy cohesion funds than has previously been used in terms of grant funding. So, I mean, I think we all know what financial instruments are: debt, equity, mezzanine, guarantees, interest rate subsidies, and hybrids between those different structures. The advantages of financial instruments as opposed to pure bird grants are basically the recycling of capital. So, you get your principal back. You perhaps even get a return on your principal, although that, of course, depends upon the nature of the instrument. And more generally, there's a second issue which enables you in certain circumstances to be able to harness the private sector. So in terms of de-risking projects and ultimately increasing competition for funding of projects, and also to be able to increase gearing, so by taking perhaps a slightly higher risk position, or by, for example, providing balance sheet support to existing funders, you're able to enable them to lend more into markets. So it's very much a key objective of the EU Commission actually in this programming period, so in the 2014 to 2020 programming period, to move member states increasingly from grant-funded operations to increase the proportion of the use of financial instruments. And that's quite a strong EU policy. The EU policy for this programming period also widened the scope of financial instruments and gave increased flexibility in terms of the way that EU funds could be used for financial instruments. So I mean, really, financial instruments themselves are just a much more sustainable way to deliver value than grants itself. There's a massive array of different sectors and different financial beneficiaries, and ultimately different intermediaries as well that might be employed depending upon the sector and depending upon the nature of the problem at hand or the need to address a funding gap. So, that might look at anything from SMEs to energy efficiency to large-scale infrastructure projects, where the final beneficiaries may be anything from the SME to an energy user, a taxpayer, a water user, or whatever. So it's a very general definition.
So when it comes to these forms, I've learned that actually equity is the most preferable now one, the version of when it comes to.
Yeah, I guess some equity certainly preferred by a number of financial intermediaries or by a number of the final beneficiaries, because it gives them some level of balance sheet support, so enables them to be able to it enables them to essentially reduce the pressure on their balance sheet. Having said that, equity isn't the only financial instrument. There are debt-like instruments which are also appreciated, and equity guarantees actually can offer significant relief. So it's not limited to just equity or debt. I mean, there's a whole slew actually, including for certain markets interest rate subsidies as well.
So which one is your favorite?
I honestly don't have a preference. I think really it's a question of what's applicable for the individual market. And here, I know there are a lot of people here today looking at the large infrastructure segment, and there are certain financial instruments which might be more applicable than others. But of course, I mean, the market in let's say large scale infrastructure, or the market in PPPs is quite different from the financial markets, let's say, for the support of SMEs, or for the support of energy efficiency, or for municipal projects, and so on. So, I mean, really, it is about devising the right instruments for the right market.
Thanks. So when it comes to the banking side, to the funding, can you please?
Yeah, sure. So, I mean, look, I think what Peter's outlined is a very interesting development and movement forward in the flexibility of European support into project situations. I mean, of course, the private sector, the banking sector, and other financial investors have been deploying financial instruments into infrastructure for a long time, because it's our base product. And I think it's a healthy trend for co-investment and co-funding type structures to be developed, because it improves the alignment of interests between the public and the private sectors in infrastructure investment, and makes it more of a partnership, which is a good thing in addressing some of the challenges that the private sector investment and development has in the political sphere. So I'm speaking generally. There's been a huge amount of development in the financial instruments market in the infrastructure space over the last 5 years. And I'm speaking here about large-scale infrastructure, new build investment. The global financial crisis led to a crisis in the ability of banks to deploy funding. They still had liquidity, but they didn't have the confidence to deploy it. That led to a sustained increase in pricing that led institutional investors, like pension funds and insurance companies, to see that in fact here was an investment product, an asset class that actually fitted their needs pretty well. That they wanted long-term investments, they wanted low-risk investments, they were happy with something that had a very long tenor, and they liked the idea of investing in real assets in the real economy that are perhaps inflation-linked, and support economic development in their domestic markets, to which they're very significantly exposed to in the rest of their business. Now, it took a while for that good idea to turn itself into actually deliverable investments. It takes, I don't know, 6 months for the idea to turn into a recruitment program. It takes a recruitment program 6 months to turn into a real team that can actually do something. It then takes that team 6 months or 12 months to actually develop a pipeline of investments that it can actually make. But what we've seen across a wide range of different institutional investors, both across Europe, from North America, and from other areas of the world, is that they've made that investment and are now capable of investing in significant big-ticket infrastructure projects using different models. Some have in-house teams and invest as principals, in effect. Some invest through fund managers. some through partnerships with banks, others by easier investments like guaranteed bonds or bonds issued by big companies that also operate in the infrastructure space. So an increasingly wide range of operating models that have delivered in projects over the last 12 or 18 months. And it's really been striking how the amount of liquidity has increased over that time with a very healthy byproduct, which is quite a significant reduction in the pricing level for assets of this sort of class, which again helps to address that political challenge of the high cost of private finance. Best thing to do is make the cost lower. And it allows projects that were previously not affordable to become affordable because the cost of maybe 80 or 90% of their cost base, the cost of debt, is significantly lower. And even better, that re-emergence of liquidity in the alternative investment market allows banks to get back into the infrastructure market with a new kind of role as structurers or arrangers or managers of those transactions, rather than providers of long-term money.
When it comes to, sorry to interrupt, but
Yeah.
when it comes to liquidity, we all know there is no problem with liquidity. So from your perspective, what's the key problem in Europe and especially in Eurozone? Why the liquidity is not reaching the target and small and medium enterprises? So it's the political issue, it's the legal issue, it's the something else. So what's the key problem? What's the key gap?
To me, the key problem is it's not one of supplier finance. It's one of supplier projects, I think. So if there's I think something to concentrate on. Not that that's an easy answer, because the supply of projects is a complicated problem with lots of different manifestations in different countries and with lots of different issues surrounding it. But I think that's where the issue is. So there's a reduction in the number of projects financed, not because of a shortage of finance, but because of a shortage of projects.
When it comes to different aspect, Luxembourg is a very favorable domicile for these activities. Can you please tell us more about why Luxembourg, was your expertise, and a little bit more about that one?
Well, clearly there are a number of reasons why Luxembourg has been so popular to structure funds which aim at collecting funds both from the public sector and the private sector. Well, clearly one of the main reasons is the fact that Luxembourg is the second largest fund domicile in the world. So the total assets of Luxembourg funds has recently exceeded the quite amazing mark of 3 trillion euro of assets. So Luxembourg is second in the world only after the US. And as Luxembourg being such an important fund domicile, it means, of course, that Luxembourg funds will benefit from a wide investor recognition globally, not only in Europe, but also in other continents, including in America, North America, Latin America, and also in Asia. Of course, while also being Luxembourg being such a big fund center, it means that basically you have all type of very specialized service providers which are established in Luxembourg. So you can find banks providing depository services, administrative agents, you have auditors, law firms, etc. So the market infrastructure in Luxembourg is very good. Another reason for the success of Luxembourg for this type of fund and investment fund in general is the fact that Luxembourg has a sophisticated yet very flexible legal regime, in particular in terms of investment funds. So for instance, Luxembourg has a wide range of vehicles which are available for structuring investment funds, meaning that the promoter can really pick the vehicle appropriate for its project and really tailor the fund to meet the specific needs of its investors and its own needs. Then there are a number of other reasons, like Luxembourg has offers a very stable political, legal, and tax environment, which is of course very important for investors. Then maybe another reason is the fact that we have in Luxembourg a number of key institutional investors which are present, including the EIB and the European Investment Fund, and which means that those institutions are familiar with the Luxembourg legal regime and they are used to invest into Luxembourg structures. So these are one of the main reasons for the success of Luxembourg for this type of fund and investment funds in general.
Sounds Then coming from the country with highest per capita per GDP, so we can turn now to Greece and ask maybe for concrete experience with financial instruments. You went a long way since 2010, the first bailout. So how introduction and implementation of several reforms, including support for different kind of businesses and financial instruments, help you to get back partially on the feet?
Okay, let me do a short introduction saying that Greece between 92 and 2008 benefited to a large extent by the use of structural funds. More or less 60 to 70 billion euros were invested in Greece during that time, and also we benefited by our entrance in the Eurozone. Those two factors, plus some others, meant that liquidity was there, and the economy was moving forward at high speed, and there was no need actually to use any other, any innovative financial instruments at that time. Even one or two that existed at the time were not promoted either by the Greek government or those that were supposed to manage them, the Greek banks. Then the crisis came, and all of a sudden we lost more or less 25% of our GDP. That affected the whole economy. SMEs, the banks, the people, everybody. Now the SMEs, many of them went out of business. Those who are still in business are struggling to find funds. They are looking for liquidity. Now the banks cannot respond to that liquidity at the moment. The Greek banks, even though they passed last month's stress test with flying colors, they have a long way to go. They're in the process of consolidation and transformation, and until the new banking environment is there, uncertainty will be present. As I mentioned already, before the crisis, the Greek banking sector, to a large extent, ignored the financial instruments that were put in place by the government or the European authorities. I remember, for example, in 2007, a presentation of a fund at the time. That fund had 200 million euros under management. For 5 years, they managed to use only 10% of that 200 million euros. And the CEO was very proud that the rest was sitting in the bank account getting interest. Things are not the same anymore. Liquidity is not there, but the banks reluctantly at the beginning, but at full speed nowadays, embrace more and more the financial instruments that the government is putting in place together with the European authorities. Also, the banking institutions are looking forward to extending their involvement in the management of the European funds of the next programming period. Summarizing, we would say that the Greek government promotes now the use of financial instruments because, as you already mentioned, they promote accountability and it's better use of the limited resources that we have at the moment. Of course, there are some points of concern.
Which ones?
Related to, not to the use of the financial instrument as such, but mainly how you successfully implement them. I will mention, first of all, the top-down approach that is followed for the design and formulation, and the long period between design and implementation, what we call time to market.
Mm-hmm.
For instance, in Greece now, SMEs are looking for liquidity, so they need as fast as possible those financial instruments to be in place, and they can take it so that they can take advantage of them. Sometimes, because usually when governments and European Union try to formulate something, it takes more time, and decision making is not fast.
So how can you fix this one? If this is, how can you fix this? So if you say implementation is the key thread or maybe a problem, so how can you fix it? How would you fix it?
It's not easy. For instance, in Greece now we have at least 3 or 4 financial instruments in use. For instance, the well-known Jessica and Jeremy, they are in Greece for many years now, but only lately, they make their impact on the economy. For Jessica, it took almost 4 years, and the first projects were approved only this year. Jeremy is at a better, the situation for Jeremy is better, but still it's not as fast as it should be.
Yeah.
Now we have the new fund, the new development fund, which was developed between the Greek government, German Development Bank, EIB, we call it Institution for Growth, and hopefully this will prove much more effective than all the other efforts so far. Let me tell you about this fund. It comprises of 3 sub-funds. At the moment, one of them, SMEs debt, is the one that we'll use at the beginning since next month, I suppose. The Greek government invested 100 million euros, the German Development Bank another 100 million euros, and hopefully we expect other institutions to join and with funds. So I would say that what forced us to use financial instruments, and we want more of them, is the lack of liquidity, and that should be something that we should have been more proactive in the past before the crisis broke. One other concern about the use of funds is that now that we have more than 1 or 2, we have to make sure that we can manage all of them correctly, in a sense that there are some reports lately that say that, from PwC, that say that those funds should not compete each other. They should complement each other. So if you have more than 1 or 2, then you have to find a way to manage those funds accordingly.
Fair enough, thanks. When it comes to funds, and maybe Jeremy is something we know also in Slovakia, and Slovakia tries to stay ahead of the curve. That's why we came up with Slovak Investment Holding. So Robert can tell us more about the baby, which was just recently born, and what he wants to do with it.
So maybe start a discussion that really the baby was born in a fire, I think, in the midst of a Eurozone debt crisis, when we sort of, with our finance minister, sort of sat around the table and what to do now. He says, that the entire banking sector in most of Europe was somehow failing. Governments were almost exiting the Eurozone. So we came up with the idea that, okay, what happens next if we resolve this crisis? Essentially, our forecast with some of the other advisors was that at some stage we will be in an economy which is or has to be deleveraged. Deleveraging essentially means that there is less and less lending to real economy. The balance sheets of most of the banks are shrinking, especially in peripheral economies. But on top of this, we realized that if we are not able to somehow support the banking sector as such, and obviously it wasn't just the Slovakian banking sector, but the entire macroeconomic sort of environment in the Eurozone, that we somehow need to supplement our banking sector is something else. And obviously, we only had limited tools that we could use. And essentially, me and other advisor, we devised a plan to sort of open up what we called at the present reversed sovereign wealth fund, which is the SIH. Essentially, we do not have gas, we do not have oil, so the only resource that was available at the moment were EU funds from the old program period. However, the regulation as such was so difficult that we couldn't utilize it at that stage, so we focused more on a new program period. But the whole idea, I mean, with the help, I think, with guys from European Investment Bank, especially European Investment Fund, when we approached the subject, they gave us few ideas how this might work in reality and how it can be structured. So that's how we approach the matter. But maybe if I go back into more theory, what was quite clear after the 2008 is that somehow the macroeconomics or the standard macroeconomics didn't apply anymore. And what the most recent findings, so I think the most progressive wings of thinking is pointing at is that the Eurozone as overall is in some sort of secular stagnation, which is very similar to what occurred in Japan. And you have to realize that in Japan they did everything to essentially stop the deleveraging and also everything to stop economy to falling in a deep deflationary depression. But in Eurozone, what occurred is we sort of started doing pro-cyclical policies, therefore we started implementing austerity, which, as we forecasted, would ultimately lead to deflationary pressures. And as you know, Slovakian economy is growing and it's still below its potential, but we are suffering deflation, and somehow the interest rates as are in Eurozone cannot be really lower. So with this zero bound that we have on interest, it's very difficult to stimulate more and more investments as far as the private sector, as was said here, is rather reluctant to lend to real economy. And the real reasons, they are pretty much diverse, but what we are figuring out is that they still deem it too risky. And for most of the businesses, it's very difficult to forecast long-term plans. So therefore, if you have a 15 to 20 years project or investment, it's very difficult to forecast what your tax will be, what your foreign exchange will be. That might not apply for most of the states in the Eurozone, but as we see, we almost in the midst of a currency wars between various, I would say, monetary blocks, and also regulation. As for banking, the regulation change and will keep evolving, which is some sort of a backlash, but it's also something quite unpredictable for most of the players. So based on this, we think that if we want to stabilize the system and make it somehow more easy for business to forecast, is to give them certain enhancement for their investment. And I think we were quite inspired by some of the projects or some of the lines of thinking, especially from the side of European Investment Fund, that we might use sort of first piece loss in order to somehow support the private capital, either in a fund structures or in concrete projects. So currently I think, especially me and Peter are trying to devise a few concrete financial instruments that, first of all, will tackle the overall cost of capital in the projects, which can ultimately benefit either the state as a concessionaire, for example, if we are talking about large infrastructure, or we are trying to devise guarantee products for the banks that can somehow release more capital. Natural question is like, why didn't you do this before? I mean, essentially, we tried to implement, and we are still trying to implement, Germany program here in Slovakia with the help of European Investment Fund. However, what was good is that we decided to continue in this and essentially top up the resources, because essentially, if you first introduce the structure to the market is not used to, there is no ecosystem, no one even knows what the financial instruments are, especially in certain ministries. So therefore, the most important factor is here that we are trying to change the culture from a culture which is purely dependent on the grants to the culture that can transform ultimately the grants into capital, which is more business friendly.
Can this be done?
Obviously it can, because one of the biggest structural challenges which I found was that if we use, let's say, grants, you are subject to public procurement rules, but if you use the capital, you are not. And let's say here in this country, public procurement is somehow awkward and somehow slow. So therefore, if you want to somehow bypass certain inefficiencies in the market, you have to use a relatively tailor-made financial instruments that they can bypass these structural deformities. So it's really figuring out the most optimal way how to channel as much needed cheap liquidity into real economy. And if this has to bypass the banking channel, of course, or if it must support or enhance banking channel, it's good as well. But ultimately, we need to decrease the cost of capital, because what most of the macroeconomists would agree is that the total factor productivity of the economy is decreasing or essentially stagnant in a Eurozone. So therefore, for investors to pursue them to plug in more cash in the project, we need to show that they are somehow protected from the risk. So therefore, it's worthwhile for them to take the risk. And, say the least, it's very important that we have the culture that is able to produce projects that are bankable, which is currently the biggest obstacle from my point of view.
Okay,
This is
so-
something that the government needs
Okay, so
to work
keep
on.
this thesis, and I'm more interested in like concrete stuff. So what kind of projects are you targeting? You will sit on a pool more than 400 million of euros, and I'm really curious. So it will be infrastructure, energy, education, R&D. So what we are looking at, and it should be tailor-made. So what do you fancy as in your plan?
Flying cars. No, joking. Really, I mean, flying cars is something very, very interesting that I came around, and for more people in this room know much better the story. But this is really something that even in small markets like ours, we can have somehow very interesting startups. And I think the flying car is really somewhere at the extreme of how innovative Slovakia can be. But we have also more down-to-earth sort of ventures, especially in IT security. But what we are currently mostly concerned with is really the big infrastructure projects. As you know, the ring road around Bratislava, D4R7, is something that we would like to see to be somehow to be used as a flagship for SIH. And also there are other projects, especially in energy. As you know, with the current geopolitical environment, you know, the supply of certain crucial inputs can be tricky. So therefore, we also want to focus on building some of the local resources, but also to do something with our power grid. So smart grids are also something that needs to be looked at in the future. And as I started, you know, the venture capital is something, especially for the younger generation, that can be somehow, or can have a huge following. And also it's about creating the culture and sending a signal clearly to the market that the money is available, and you somehow have to become accustomed how to utilize it. And once the people fully appreciate and understand this, then we can have the entire ecosystem built around not just SIH, but also with the help EIB, EIF, and other IFIs and private investors to really provide all the right channels that if you have a good idea, you have a good project, which is well structured, which is bankable, then we have available financing that can, it's extremely competitive in terms of rates, and it's sort of, it's user-friendly for the ultimate beneficiary.
Okay, so let me stop you right here. So I hope you have a general overview of what it means. And I have one more question, not for them, for you, if you don't mind. And I need a volunteer, unless I pick someone up. If you hear all the talk about that the Commission, the EU, the EIB, the governments wants to roll over and just overhaul the system of economy, which is bank finance, into something which is more US based. I would like to hear your opinion if this is possible to do in Europe or not. And so what do you think of it? Anyone? Please.
The shift from bank to capital markets has already taken place. It's taking place now, so it's a fact. It's going to develop, it's diversified, and it can continue, there's no doubt.
And you are optimistic that actually we can balance it to the level which we see or can see in the US, for example? Because they are capital market-based economy, Europe is different, so what's your opinion about this one? What needs to be done?
Clearly, the classical figures, in being simplistic, is that it is 80-20 on one side and on the other. We can shift relatively quickly from 20 capital markets to 30 and 40. There has been a fantastic shift in the behavior of the investors. They have acquired teams. We did, by the way, I'm HSBC. We did a first project bond, a securitization in France. We as a bank took the construction risk, but because at that time the investor did not want to take it, and now they want to take it. So they are moving very quickly for several reasons. First, the rate of interest of govies is no more interesting for them, so they have to do something else. Second, they are very happy to get a better yield, and the fact that it's less liquid for them is not a problem because they are long-term investors, so this shift is very natural. And what, of course, and also they are getting used to it. So the margin were very high when they started, and now it's regularly coming down. And if we are able, I mean, the public sector and the advisors and the structurers to give them security, stability, clear legal framework, the margin will keep on getting down.
Yeah. Any reactions? Anyone?
Because I can agree on stability bit.
Sure. No, I mean, I think I would agree completely. I mean, I think, and I'd agree completely with Trevor's earlier market analysis. I think I'd just complement it maybe to say that I think that was a market analysis for, particularly for PPPs or large-scale infrastructure, rather than necessarily for SMEs or some of the other market segments. And perhaps add to that I mean, I think whilst there is a very liquid market of funders, there is still, I think, a flight to quality. And so there is an element that there's an incredibly competitive market for large-scale infrastructure within the UK and within Germany, and very, very active institutional investor groups there. I think there's still an element that, unfortunately, a country like Slovakia is still faced with paying an element of the sort of liquidity emerging market premium, which I'm not sure is terribly fair 25 years after having emerged, but I think that does still exist, and therefore any initiatives which I think help push that in the right direction, including, as you're pointing out, the capital markets transformation that is going on, and also financial instruments to support that, are only positive.
And we have taken many issuers to the market, and it's always the same story. When you're new, you pay a high premium because you have to gain confidence. When you gain confidence, the premium go down. I think it's true for issuers, it's true for corporates, it's true for governments, it's true for projects, it's true also for legal systems. Once European countries, all of them, either the same or similar, have very transparent rules, very clear rules, the margin will go down.
Of course.
Yeah. I have one more question. I see you are Kotvian for Erste Bank, and I would like to ask you, we heard the word liquidity, and there's ample of liquidity in the Eurozone and also in Europe, so why are you not lending out to the real economy? I mean, not Erste, I mean like banking sector in general. Especially for SMEs.
At least what I can see, there is a lending in Slovakia in the housing market, so the loans have been increasing. But I think in the previous panel it was mentioned by Mr. Stepic that regulation, especially the AQR and all related, I would say, uncertainty, put I would say, lending a little bit on back burner. So there was a huge uncertainty about what might pop up, what kind of consequences they can have. So meaning that all banks, they try to keep their capital buffer as large as possible. So I think that was a temporal phenomenon. And then also there is uncertainty about the growth prospect. So meaning that businesses, there is enough. There might be enough supply, but the demand is relatively weak. The companies, they are also full of liquidity, and they're repaying loans. In some countries, it's also regulation, like the banks, they are not allowed to provide FX loans to unhedged borrowers, so we can see some kind of deleveraging on these markets. So that's happening in Romania, Hungary, Croatia.
Okay. So now going back to normal, I would like to invite you, if you have any questions for any panelists, raise your hand, ask a question, please. There's a gentleman to the left. Go to that.
I want to ask if Slovak Investment Holding will issue or hold water bonds with maturity about 10 years, because it's known that Slovakia, although it's a very little country, but it's one of the powerhouses from the point of view of underground water reserves. It's one of the 3 countries in Europe that have most water reserves under the ground. So, of course, for investor it's hard to forecast future conditions for his investment, but there's no brainer for water investment that it will be future and very bright future. So, will you think in some ways about water bonds on, or say, water equities for longer term?
So, to answer your question more precisely, I mean, currently we are bound, as far as our first tranches of capital will come in the form of European investment and structural funds. We are somehow bound to the operational program, which are so far, to my knowledge, not really considering this asset class to be eligible. But on the other hand, we are creating really infrastructure that will be able to soak in, or as in the philosophy of reversed sovereign wealth fund, can soak some liquidity from other sources, and I can imagine that some Middle Eastern investors might be essentially interested in such a products. And as you mentioned, yes, in the future Slovakia can ultimately become something like Saudi Arabia in terms of water resources, because clean water is something that's becoming a problem in many places of the world. So, as I said, SIH is not purely the EU funds, it's really about the infrastructure which will enable similar investment as you just mentioned. But at the current setting, with our current money, where all the strings are attached in terms of regulation that we need to comply with, which is given from the side of the Commission and a common provision regulation, we can't do it. But for maybe mid-term future, this is clearly an option.
Anything else? There's a gentleman.
Hello, Alex Lehman from EBRD. So what we've so far discussed is basically that the financial instruments so widen the availability and in a way leverage the use of structural funds. The original strategy document for this new phase of structural funds said that in fact financial instruments should help to calibrate the use of grants and basically tailor them in line with the extent of market failures, so that there may be some sectors or some countries where the grant element could be quite small and the financial instruments used could be quite extensive, and others where the grant element could be dominant and could possibly decline over time. And as markets build up and the use of funds becomes more self-sustainable and commercially oriented, then the use of grants could gradually decline. So I wonder whether the panel had any views as to how the use of instruments could be differentiated across countries and across sectors, or operational types of programs that are used in structural funds.
Again, I would say that we're also talking, if we start comparing like grants and financial instruments, especially from a European structural investment funds, and we are talking about distortion of the market. And I think essentially it's lots of people, especially on the right side of the political spectrum, that are complaining that the grants are essentially destroying any sort of competition, because usually it's how to apply and essentially how to get the money from the public sector in the form of grant. If we compare it to financial instruments, then it's a more business-like approach to the problem, which has its own advantage, and again, is about the building a culture and the direction we want to move into. And essentially, what the problem is that in the future, the allocation of the EU funds will be not as large, especially in the case of Slovakia, as our economy is genuinely growing. Therefore, we need to have some sustainable layer of readily investable funds for the future generations. I mean, I'm not literally talking about the end of this operational program, but something that can be used and reused, maybe even for a generation or two. And this is the clear aim, to have some stable layer of a funding, which is not somehow accounted towards mastering debt, which is also a massive problem, and somehow can cover the key investments that we perceive in Slovakia to be useful to us. So really, it's about the culture, infrastructure, ecosystem, and what we are talking, or what is very unique term nowadays, which is the financial sustainability. I mean, really, how can we make the financial system to be sustainable? And to also fulfill the social contracts and social goals in the meantime.
And I think your point is very much taken, but I think the European Commission are very much trying to move member states from grant funding towards financial instruments, absolutely, and towards a more sustainable funded solution. Of course, you can't necessarily overnight move all EU support from grants to financial instruments. It simply wouldn't work and wouldn't make sense. And clearly, in some places where countries have problems absorbing grants, then they're going to have problems constructing, creating, and managing and implementing financial instruments. But clearly, it's both in the Commission's interest, given the limited resource available, and also in the member states' interest, in order to maximise the amount of utilisation of financial instruments, and that's very much the push of EU policy.
And I believe it's a matter of mentality. I mean, to go from grants to financial instruments, it's a huge task for all parties involved. The government, the authorities, the local authorities, the SMEs, everyone who is on that cycle. It's very difficult to move from one side to another. However, there will still be in the European Union projects that will be impossible to materialize with financial instruments. You need the grants because it's a matter of, how to say it, some projects are not bankable from their own nature. So you need the grants, but you need also the financial instruments to move forward, to exit that economic crisis, and to make sure that the future generations, they have the possibility to move along as we did.
So maybe there's one more question. So we are talking about obstacles and problems. So when it comes to the transformation or movement from grants to financial instruments, maybe Trevor, what are the key problems or risks in the short and mid-term when it comes to creation or recreation of this framework?
Well, I suspect if I turn it back into a question about the delivery of projects into a pipeline, and I'm going to keep on talking about infrastructure as that's the area I'm interested in. The development work of the way in which the financial instruments are going to be deployed and implemented needs to be worked through pretty quickly in order to make sure that any uncertainty or multiplicity of choices about mechanism of implementation doesn't slow up straightforward project implementation.
Okay. Maybe I can just add to that. I mean, clearly for any, whilst I think financial instruments are a fantastically wonderful thing, it's not that one creates a financial instrument and is then able to open the door and ship the money out the next day. But there's a great deal of work that needs to go on in terms of the construction of the institutional framework. There's a great deal of work that needs to go on in terms of the regulatory framework, the legal framework, or the adoption of an appropriate legal framework, be that in Luxembourg or be that elsewhere. There's a great deal of work that needs to go on in terms of the setting up of an institution, the insurance of appropriate governance policies and so on. I mean also really also some strategic questions in terms of understanding exactly what you're going to target and how you're going to target those. because clearly there are a whole suite of different instruments and there are a whole suite of different markets, and one could try and target everything, but that's clearly fundamentally not possible. And there needs to be a clear strategy in terms of exactly what an entity wishes to do in terms of, for example, the level of subvention funding that it wishes to generate, i.e. the level of public benefit it wishes to pass to final beneficiaries, be those SMEs or taxpayers or energy users or whatever, and the level of gearing that one wishes to try and ensure in the structure, and the level to which one is trying to gear up the financial structure and incentivize other entities to lend and so on.
There's one more question related, maybe Jean-Christian could shed some light and tell us. Sometimes it's challenging to pull and to attract at the same time private and public investments. So why is that, I guess?
Well, I think it's challenging because private investors and public investors generally have different objectives. While the private investors obviously are looking for the best target return or risk return profile for their investment, whilst public investors may have different topics on their agenda. For instance, in the case of the Greek initiative or the Slovak initiative, the public institutions behind the project are probably willing to try to fix a market deficiency or to close a gap in the market. So it's really important that it's not really easy to align the interest of the public investors with those of private investors. And a way to achieve that, at least in terms of the product that you're selling to private investors, is to use subordinated securities, i.e. basically to issue first-class securities to public investors in order to improve the risk-return profile of the participation of private investors. So that's one way to do it. There are other concerns for private investors when they invest in those kind of funds, where there are, I would say, where there is also public objective which are pursued by the relevant initiative, is to make sure that somehow the fund will operate based on market terms, meaning that seek to limit political influence on how the fund will be managed and how the relevant investment will be selected.
Maybe Robert?
This is precisely what it is, that somehow the capital which is provided from the public sector is somehow subordinated to more senior or private tranches, and somehow the political independence of the projects is guaranteed, either explicitly or implicitly. And also it's regarding the use of financial intermediaries that we somehow didn't speak about, but it's very important and it's a part of this ecosystem or infrastructure that we are talking about, that the market itself is somehow ready. So either it's the banks, asset managers, venture capital, fund managers that are ready to deploy these instruments. So it's really from regulation to predictability to really good corporate governance and also good politics. And this, if combined, somehow can improve the market to the extent that these inefficiencies that exist structurally are somehow improved to the degree that we can have sustainable, stable finance and sustainable growth. And this is the key message which is resonating among theoreticians, macroeconomists, and politicians. But really difficult to achieve, and I'll tell you exactly why. I mean, there's lots of bureaucracy involved, and it's really hard to change few texts in certain laws, because so many people that would tell you that this would essentially mean a disaster for the whole system, but sometimes you really need to go and push it hard, and also you need to have this mentality to continuously change and improve the framework and the laws and regulations that you have. And Luxembourg is actually one of the good examples that, okay, the good governance can happen. So we think that, if we in Slovakia or in Greece, as you went through many and many rounds of structural reforms, which were extremely painful, especially for young generation, that you come up with a stable framework that will somehow not allow this extreme that happened after the 2008 to occur in Europe. So this is really the key message. And financial instruments, it's one important part that should be pursued as a general policy.
Right. Peter, anything else?
No, nothing to
Any more questions from the floor? Gentleman over here.
Thank you. I'm Harold Weiglein from the Austrian Treasury. And I'd like to briefly come back to an intriguing question that had been asked before, namely the question of whether we should turn into a market-based economy here in Europe in the way that the US is. I think the more interesting question is not whether it can be done, because I think it can be done, but why would we want to do it? I mean, historically, the US is the way it is because banks weren't allowed for a long time to invest in equity. So they had to find another channel. We don't have that situation in Europe, and whenever we discuss that question, market-based versus bank-based system, the underlying assumption seems to be that the market will somehow bring in additional funds that can be used for additional investment. Now, the general mood here seems to be that there aren't enough projects. Now, if we don't have enough projects, but we try and change the system to a more market-based system, to my mind, what will happen is that maybe the market will just replace the banking channel. So we won't have additional funds. We will hit the profitability of the banking sector, and I'm not sure whether the funds that will come through the market will be cheaper for all those seeking loans or credit than the banking channel. Because who goes to the markets? These are normally corporations with a top rating. They can access funds more cheaply in the market. But what about SMEs? And I don't mean to totally sound as if I was against the market-based system. I'm not. I think it's a very useful pillar. But these are some of the questions I've been asking myself, and frankly, I don't have an answer. Maybe somebody on the panel here is a better man than I am.
Well, I mean, I think there's two things in there. I mean, SMEs and infrastructure are really different things when it comes to the funding challenge. In infrastructure, the move to market-based funding has already happened. If you look at a list of the projects that have been funded over the last 18 months, most of them will have been funded by institutional investors. And even if they look like they've been funded by banks, in fact, it will be banks working with institutional investors in the background. So that disintermediation, if you like, of the banking sector for large-scale infrastructure projects has happened, and it's there are some good underlying drivers for that, and I think we're in a situation at the moment where the amount of appetite amongst the likely investors for appropriate projects is much larger than the pipeline of projects in any particular year that you want to look at it. And the consequence of that has been a price reduction, not a price increase. And I think the liquidity is sufficiently large that it's difficult to imagine the pipeline increasing to the point where that appetite for investment isn't satisfied.
I would supplement that a little bit by saying, I mean, I'm not the best person to speak about the finance market for SMEs because my background isn't SMEs, and I see guys from the EIF who have vastly more experience in the structure of the financial markets for supporting SMEs. But obviously that is a market that is more dependent on banks and is more dependent on banks' ability to take risk. And there clearly, okay, SMEs are also a very important part of the driver of an economy. So I would agree with you completely that you don't want to switch from one model to another. Actually, you want both pillars to be well functioning, to have a well functioning economy. I'd agree again with Trevor that the switch has happened. However, I think in terms of coming back to the point I made earlier about a flight of quality, we do see banks active even without institutional investors in some of the let's say the highest quality, if you like, and highest rated European markets in the likes of Germany and the UK and so on, and offering very competitive terms. So not only performing roles that would relate to institutional investors, but also performing lending roles and so on as well. And I think that's healthy as well, actually. So, I mean, I'm not I'm very positive about the involvement of institutional investors, and I'm absolutely delighted that institutional investors have embraced the infrastructure market and have included teams and have built associations with banks and so on, and the various different approaches that they've taken in order to be able to support that market. However, I don't think that precludes or reduces the importance of the banking market either, and I think the banking market will also always be very important. So here I think we're not talking about trying to favour one system over another, we're actually just trying to raise the bar across the piece.
Yeah. A liquid distribution market for long-term paper allows banks back into the market as originators and distributors, which is what they used to do pre-global financial crisis. So, they fronted deals, but then they syndicated them afterwards. So.
And also maybe an example of Slovakia, we don't really have the second pillar of some market. I mean, there is limited market on like state paper, but I mean, pretty much that's it. And if you're a venture capital firm, I mean, the best option for you is to really move out of the country. I mean, simple as that, maybe.
And the case of Greece is that at the moment, because our banking sector is suffering, we need financial support through financial instruments that will bring along private investors and venture capital.
Please.
Yes, I would like to make a quick comment on what bank can and cannot do on infrastructure and on SMEs. And it's funny to see the two problems bundled together because both are very important, but they are totally different. I suspect that politicians or technocrats put it together to have the momentum of both, to have the train advancing, because really it's totally different. But anyway, banks are not efficient entities to finance very long-term maturities for a simple reason, and it's technical reason. Either we refinance ourselves at the same maturity and we will pay a higher margin than the project, which makes no sense, or we refinance ourselves much shorter maturity, and we do transformation, we take a transformation risk, a refinancing risk, and this is something which can be dangerous. Many banks lost their life for that, and the regulator will be more and more against it. So 30 years, 20 years, it's not for the banks. It's true that today the reality is a bit blurred because some banks, except to have 1 or 2% of a balance sheet, have those maturities, but this is not an economic way. On the other side, for SMEs, I personally think that banks are very well equipped, much better than the market, to deal with SMEs, because first, they do case-by-case analysis, which the market cannot do for mid-cap or SME. Second, banks make their life with the flows, with their FX, with the ancillary business, which the investor will not do. So I think that there is a great future for bank as financier of SMEs, and it has to go to the market for infrastructure. I would have one question for the EIB. In fact, it's not the first time that EIB take EU money to transform it and put some leverage. There was the LGTT, there was also the project bond credit enhancement. In fact, could not the EIB and the EIF do the job for the rest of it?
Well, I mean, it's certainly not the... and thanks very much, and sorry, the reason I mentioned SMEs, I would agree with you completely, in that they're sort of completely opposite ends of the spectrum, but given that they're both eligible under financial instruments and under ultimately SIH's work plan, I guess, I wanted to highlight the different ends of the spectrum. In terms of, EIB and EIF's involvement, clearly, we absolutely do have a very wide-ranging experience of creating and operating and implementing and managing financial instruments. You mentioned LGTT, Loan Guarantee for Transport 10s, PBCE, the Project Bond Credit Enhancement Initiative. Jeremy, I think, was mentioned to support SMEs. Beyond that, I mean, there's many more, actually. The RSF to support research and development. And also energy efficiency products and so on as well. So there's actually no shortage of these at the EIB. There's if anything, rather a lot. And I think Those are all absolutely appropriate. Typically when EIB, and I would include EIF as well, I think typically when the EIB group is working on a financial instrument, it's working on a financial instrument mostly on a pan-European basis. There are obviously exceptions to that rule, but mostly that's worked on a pan-European basis. Where obviously here what we're talking about is the implementation of financial instruments very specifically in Slovakia. So we're talking about a very tight geography, but a very, very wide range of sectors, as opposed to more typically in the EIB group, you're looking at, let's say, a single sector, but on an EU-wide basis. But absolutely, are we working with SIH? Absolutely, in terms of the sort of instruments that we have created previously and that might add value into SIH's work plan and so on. And we're very, very happy to do so and to provide any assistance or support we can.
And also maybe add to this is also, again, the same culture ecosystem, because let's say not that many people are actually aware that EIB exists in Slovakia, and if they heard something regarding some European bank, they usually think ECB. So it's also important to have a local knowledge to somehow even translate these instruments which are available at pan-European level to a concrete projects here in Slovakia. And somehow most of the time I have this feeling that this is missing. And also you need to train people, human resources, to able to comprehend, explain it to politicians, and explain it to media that these solutions can be applicable. So also you need to have a very strong pan-European solutions, but for very specific cases such as Greece, even here in Slovakia, you perhaps must fine-tune certain financial instruments and to bring more tailor-made products to the market, and also train your local people that are able to understand. Essentially, it's, I have to actually say, because here we have EIB and we have also EIF in auditorium, that we already done some essentially exchange. We done some secondments which are tremendously important, and we will continue to do this on a steady basis. So it's also the human resources and spreading the know-how across various states. So I think this international experience can give us as Europeans somehow a way forward. So it's not just socializing with the drinks, but mostly we are talking either rates, models, and structures, which is even more interesting at some point.
There is one more question from the floor.
Andrej Šrámek, Knauf Insulation, Czech Republic. Sorry to bring energy efficiency up again. It's just my thing, I can't help it. I want to challenge the notion that there are not enough projects, that there's lack of projects, which has been mentioned a couple of times. An example, in Slovakia, I believe there's something like 800,000 single-family homes. So there you have 800,000 projects. Now, of course, I realize it's incredibly difficult. It's very scattered, very fragmented market. But just to say, in Europe, the total floor area of all buildings is roughly the size of Belgium. So if there was one gigantic building the size of Belgium, I'm sure all banks would be all over the place. Unfortunately, that's not the case. We have those buildings scattered everywhere, so it is difficult to manage that market. But whose responsibility should it be to develop financial instruments and financing mechanisms for this market? It's definitely not going to be the homeowners. They don't have the capacity. It's definitely not going to be the small installers, garage companies, SMEs. Everybody's talking about SMEs. Guys, one, two people companies that put up insulation and stuff like that. Those are not going to be the ones who devise these complicated measures. So I'm kind of challenging a little bit the financial world. Whose responsibility should it be to figure out how this market should kind of kickstart? I would be happy to hear comments from anyone who would like to comment. Thanks.
Sure, maybe to come straight to you, Iva. Do you mind if I jump in? Or, look, I absolutely agree with you that in terms of energy efficiency projects, probably both in residential and probably public buildings as well, there is no shortage of projects in Slovakia, at least from what I've seen. I think the discussion about a shortage of projects is really within a rather specific large infrastructure market for PPPs in Europe, not in, let's say, SMEs and energy efficiency and perhaps a wider basis of the economy. So it's absolutely true. I think that energy efficiency is one area where there is no shortage of projects, and there is a need to try and address the funding challenge there. The funding challenge in energy efficiency, I think, is also not to be underestimated in that it isn't easy to deliver instruments to energy efficiency, as I'm sure you either to housing associations or to individual entities that have responsibility for energy efficiency works, and in order to ensure that the loans actually catalyse an energy efficiency improvement. So that's certainly an area that I think is being looked at, and is being looked at as a part of the ex-ante analysis, which is the analysis that supports the use of financial instruments in the programming period from 2014 to 2020. And as a part of that analysis, and the final part of that analysis is coming out with an investment strategy for the relevant sectors. Clearly energy will be one of the relevant sectors for that, and energy efficiency will be one part of that will need to be considered. And that's being considered actually. The ex-ante analysis itself is normally written by a member state, by the Ministry of Finance, and then submitted and approved by submitted to and approved by the European Commission. But that's working with other managing authorities, so in particular managing authorities that would have responsibility for energy efficiency programs and so on.
And it's probably right to say that when you can identify a responsible authority, so for example across public buildings within a local authority area, or within social accommodation, so municipality-owned public housing, there are schemes that can deliver on some sort of PPP basis investment into those kinds of problems. It's harder in privately owned residential schemes for sure, and then I think you have to fall back on some sort of grant type model.
Also, I think from practical experience, I think what we are actually conducting the ex-ante analysis with the help of the EIB, is that if you pressurize enough certain authorities, they essentially come up with some projects. So this project discovery is also a bit of a cultural thing, and sometimes, we were approached with very extreme sort of reactions that we asked who is responsible over urban development, and the answer was something like, what is urban development? It's not defined. So we essentially defined the sector, like this is the urban development. And if you go outside and you look in Bratislava, which is pretty much developed, obviously it's not that much developed, and it can be sort of more development going on than it's at the present. So I think, I believe projects are out there. They just need to be identified, structured, and become essentially bankable.
And who should identify these projects, and how?
I mean, if it's not the private sector, then we have some structural problem. Obviously, it must be authorities that and ministries that somehow must be forced to do that. And sometimes it's not enough just to tell people, but it's really to educate people and tell them you have to go and find out these projects. Let's say we are trying to put together for the Juncker's initiative for 300 billion project pipeline. And I think if we would have not done the ex-ante, we will not come up with as many projects as we have on the list right now. I mean, this is completely different topic, but it's really about the culture. To tell the public servant that, yes, you need to look for the investments, not just general policy. And perhaps this might be approach which is viable for some countries. It might behave differently in more developed economies. But our experience here in Slovakia is that you really have to go and chase people. And once they get somehow used to that, okay, if someone is asking me something, then I have to essentially look in a matter in more deeply and think about it. So again, it's the way of thinking, and also it's the cultural thing that needs to change here.
Let me give you an example from the UK, actually, in the airport space. It's sort of about how high-level government intervention can nudge inventive thinking. London's got 5 airports. It's not a very efficient system. One of them's really busy. I won't go through all the others. And it's a regulated economy. And a regulated infrastructure economy. It's very good at managing incremental spend and managing down costs, but it's not that good at coming up with brilliant ideas for very, very large new investment. So what the Mayor of London did was propose an enormous new scheme in the Thames estuary, which is really expensive and involves closing down some of the other airports. So there are now 5 existing airports and 1/6 potential incredibly expensive new airport. Now, what the existence of that 6th scheme has done has made all 5 of the other airports, which are now all owned by different people through a program of privatisation, come up with their own schemes to compete with that very, very large spend on the 6th potential airport. And inventive ideas about what are comparatively cost-efficient schemes, but still much larger than anything they would have come up with before that push, are now on the table and being considered for the solution to London's airport problems. And I think it's quite an interesting example of where the push for the inventiveness in terms of project identification and useful investment ideas came from. So the government's got a very important role for sure in many sectors about managing competing demands and identifying different opportunities, but it's not the only answer.
Also, sometimes you need to nudge the government itself.
Yeah.
For doing it.
Nearly always. One more question so we can conclude. Anyone? That brings us to the end, maybe. We can all broadly agree, like, investments and financial instruments are sexy and it's going to maybe happen. Anyone wants to conclude? Maybe Peter?
One question.
Wrap it up. One question. I'm sorry.
Maybe there are many projects in energy, but in water, there's a total lack of water investment projects. In Slovakia, for example. And I'm wondering what to do with this total deficit.
Drink it.
maybe to develop some type of administrative vehicle or maybe bank for investment water projects and or other projects in sense to concentrate these projects and find ways to create them. If it's something specializing in identifying projects, it will be more productive. And I don't know whether this type of administrative vehicle or bank of finding investment projects exist somewhere in Europe.
Anyone
Will it be possible to think about it and to gather some specialists and maybe...
Just to maybe come back on why we're able to respond perhaps on the energy efficiency in a slightly different way to the way we responded on the water, for example. The reason we were able to respond on the energy efficiency in that way is ultimately, I guess, SIH's first priority is really to implement the results of an ex-ante analysis, which looks at and is basically the implementation of an investment strategy defined under an ex-ante analysis, where ultimately the process that's been gone through there, the managing authorities have each gone through their operating programs that they need to agree with the European Commission, and they've looked at what eligible expenditures exist in each one of their relevant sectors, and from that they've identified areas where there needs to be investment, and ultimately therefore where there need to be projects, and those projects would be eligible under the terms of EU funds and under the terms of cohesion funds in particular. And then from that we can identify that, okay, that's the gap, if you like, of projects that need to be funded, and we have this, or the SOGACs have this pot of cohesion funds that they can use in developing financial instruments to support those projects. So there may very well be water projects in there. Actually, obviously this is a rather all-encompassing analysis, and as I explained earlier, I'm more of a large-scale infrastructure guy than I am an SME or a water or an energy efficiency guy. So I apologise. there are significant limits and significant holes to my knowledge. But in terms of, let's say, the first priorities of the projects that are being assessed as this process, they're obviously projects which are eligible under the terms of cohesion funds. So I guess the first question is whether there are water projects that are there under the operating programs of the different managing authorities, which are basically eligible for cohesion funding. If not, then of course that doesn't mean that water projects aren't good projects or that water projects shouldn't be funded, but it simply means that they're not the immediate target of that process, if you like, of that implementation of an investment strategy process. Does that help?
Exhausting enough? So we're nearly done? No, we're done. So this concludes the discussion. I hope we exhausted you as well a little bit. Thank you to all. And
Thank you.
see you soon in Bratislava again. Thanks.
Thank you.
Have a
Thanks
good
a lot.
evening.
Thank you.